Welcome to the channel. Today we're tackling a hard but empowering message. If you're around age 37 and feeling behind on savings, now is your moment to change your trajectory. We'll break down the 15% rule, show a clear priority roadmap for your money, and share practical steps to build momentum in the next 30 days. We will also cover emergency funds, debt elimination, tax-advantaged accounts, and how to automate your investments. Then, we'll test your knowledge with a couple of quick quizzes. As we move from one section to the next, I'll give you specific actions you can take immediately, so you finish with a concrete plan. Here is today's plan. First, we will frame the urgency and opportunity for late starters. Next, we will unpack the 15% savings rule and why it matters at age 37. Then, we will walk through the priority flow for your dollars, followed by a 30-day snapshot exercise to fix your budget. After that, we will design the right size emergency fund, and then set up automation to make saving inevitable. We will also discuss simple, low-cost investing with index funds. Finally, we will do brief quizzes to recap, and we will end with key takeaways and next steps. Before we proceed, a quick but important disclaimer. This content is educational and not individualized financial advice. Everyone's income stability, debt profile, family responsibilities, taxes, and risk tolerance differ. Therefore, consider consulting a qualified fiduciary financial advisor and reviewing your tax situation before implementing any strategy we discuss. With that said, let's transition into the wake-up call and opportunity in front of you. Here's the wake-up call. If you're around 37 and haven't been saving aggressively, waiting longer dramatically raises the savings rate you'll need later. However, here's the opportunity. With focused action now, you can still hit a comfortable retirement. Compounding favors early and consistent contributors, and even in your late 30s, you can build momentum quickly by increasing income, reducing spending, and investing the difference. Therefore, we will keep this simple and action-oriented. Let's clarify the 15% rule. Starting around age 37, target at least 15% of your pre-tax income directed to retirement accounts. If your budget allows, push toward 20% to build a margin of safety. Prioritize tax-advantaged accounts, such as employer plans and IRAs, because tax deferral or tax-free growth accelerates compounding. Automate contributions from each paycheck so the habit is effortless. Keep your investment menu simple by using low-cost diversified index funds across U.S., international, and bonds as appropriate. A simple formula to monitor progress is savings rate equals total retirement contributions divided by your gross income. Next, we will map the priority flow for every new dollar you earn. This flowchart shows the order of operations for your dollars. First, build a small emergency buffer between $1,000 to $5,000 in a high-yield savings account. Next, eliminate toxic, high-interest consumer debt, generally anything above 10%. Then, capture free money by contributing enough to your employer's plan to receive the full match. After that, expand the emergency fund to 3 to 6 months of expenses. If you are self-employed, you need 12 to 24 months due to income volatility. Subsequently, maximize tax-advantaged accounts, beginning with IRAs and then workplace plans up to the annual limits. Finally, invest remaining funds in a taxable brokerage account with low-cost index funds for long-term growth. This ordering reduces risk and increases resilience while keeping you on track. In the next 30 days, track every expense. Use a budgeting app or a basic spreadsheet, but be thorough. Next, categorize your spending into needs, wants, debt payments, and savings. Then, compute your savings rate by dividing total retirement contributions by your gross income. After that, identify your top 3 cuts that can free up 5 to 10% of income quickly. Finally, set up automatic transfers that send this freed-up cash directly into your priorities from the roadmap. By doing this in sequence, you create immediate clarity and momentum. This table illustrates the trade-off between starting age and required savings rate. Starting at 27, a 10 to 12% rate may suffice because compounding has decades to operate. By 37, the realistic target jumps to 15 to 20%. At 45, you may need 22 to 30% action. By 50, the requirement can reach 30 to 45%, which many households find impractical. Therefore, the earlier you commit, the less extreme your savings rate needs to be. Your first line of defense is a small emergency fund, typically between $1,000 and $5,000, placed in a high-yield savings account. Next, After you've captured your employer match and eliminated high-interest debt, expand to a full emergency fund. If you are a W-2 employee, target 3 to 6 months of essential expenses. If you are self-employed, set a goal of 12 to 24 months because your revenue can be lumpy and uncertain. Keep this money liquid and safe. It is not for investing. Whenever you dip into it, schedule automatic transfers to rebuild it promptly. This sequence diagram demonstrates how automation should move your money. First, direct deposit lands in your bank account. Then, before discretionary spending, funds route to fixed bills, your emergency fund via automatic transfer, and your retirement contributions through payroll. Next, monthly transfers flow to your IRA or Roth IRA and then to your taxable brokerage, set to auto-invest in index funds. By paying yourself first, immediately after payday, you remove willpower from the equation and maintain consistency. Quiz time. The question is, for self-employed individuals, what is the recommended emergency fund size? Option A, 1 to 3 months of expenses. Option B, 3 to 6 months of expenses. Option C, 6 to 9 months of expenses. Option D, 12 to 24 months of expenses. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 12 to 24 months of expenses. Because self-employed income can be irregular and subject to economic cycles, having a larger reserve stabilizes your finances and prevents the need to sell investments at a bad time. Here we compare index funds to stock picking. Index funds typically offer very low fees and extremely broad diversification, reducing the risk that any single company can derail your portfolio. They require minimal time and attention and, over long horizons, tend to outperform the majority of active strategies after costs. In contrast, stock picking often involves higher costs, greater concentration risk, and significant time commitments. Moreover, evidence suggests that consistently outperforming the market net of fees and taxes is rare. Therefore, for most investors, index funds are the more reliable default. This is your investment priority stack, restated for clarity. First, build a starter emergency fund. Next, eliminate high-interest debt. Then, capture your employer match. After that, expand your emergency fund to the correct size for your work situation. Subsequently, maximize your IRA and workplace retirement account. And finally, invest in a taxable brokerage using low-cost index funds. As a quick markdown checklist, multiply your gross income by 15 to 20% to set your target retirement savings. Automate contributions through payroll and monthly transfers, and rebalance once a year or when allocations drift materially. By ignoring market noise and sticking to this plan, you make steady progress. Here is a second quick quiz. The question is, if you delay saving until age 50, what savings rate might be required to catch up? Option A, 10 to 12%. Option B, 15 to 20%. Option C, 22 to 30%. Option D, 30 to 45%. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 30 to 45%. Delaying until age 50 compresses your time horizon so dramatically that you must contribute a much higher percentage to reach similar outcomes. Therefore, starting now at 15 to 20% is far more feasible. Let's crystallize the key takeaways. First, if you are around 37, target a 15 to 20% savings rate. Next, follow the priority flow to allocate dollars effectively. Then, automate each step so saving happens without friction. Use low-cost, diversified index funds to keep performance reliable and fees minimal. Finally, if you are self-employed, remember that your emergency fund should be substantially larger to offset variable income. As we conclude, take 3 decisive steps. First, begin a 30-day expense tracking period. Second, within a week, establish or top up your starter emergency fund. Third, this month, automate 15 to 20% of your gross income into retirement accounts, and schedule a quarterly review to adjust and stay on course. By moving promptly, you convert urgency into momentum. Thanks for watching. If this video brought you clarity or motivation, please like the video, share it with someone who needs a financial reset, and subscribe for more practical guides. In the comments, tell us your next action, your first cut, your new savings rate, or the automation you set up today. Your story may inspire someone else to start now.